And just before we move on to the markets in this region, let's take a look at the banking sector just a little bit, because as we approach the second quarter bank earnings season that kicks off this month, it's really expected to set the tone for the stock market in the second half of the year. Banks now face a higher interest rate environment and the central bank that continues to emphasize risk management. What does all this mean for bank earnings going forward? Joining me in the studios to discuss this is Adeolu Omotola, a banking analyst at ARM Investment Managers. Adeolu, thank you so much for joining us. So like I mentioned, this bank earnings season, I think, is going to be very important in setting the tone for the rest of the year. And I want to get your broad expectations, given the way the environment has changed in the last 6 months. Clearly, at the beginning of the year, it was a much lower interest rate environment. We've seen that sell-off in the bonds market, although now we're beginning to see prices pick up again, but relatively it's still higher now than it was a couple of months ago. So what do you think all this means for bank earnings? What can we expect in Q2?
Morning, Wale. I think you rightly hit on the main talking points. The environment really is a bit different because for the banks, they have to grapple with higher funding costs, which I think is significant for them as a whole. I've seen that already inch up in Q1 2013. But beyond that as well, revenue creation, as you've also mentioned, just looking at opportunities in the bond market. But what we think could be very significant for the sector is some of the regulatory changes that kick in starting from this quarter of earnings. Exactly. So we have that control on bank charges. We have limitations on what they can do as per SMS alert.
Do you think it's significant, those changes in in terms of controls or in terms of charges?
No, for both. For both. To give you an instance, for First Bank, for instance, thinks that on SMS alert charges alone, they could be losing almost up to 4 billion in revenue, for the year, which may not be a big deal for someone of the size of First Bank, but for some of the smaller banks, it could be a significant chunk of their earnings. Same thing goes for funding costs as well. CBN has said that savings deposit rates has got to be a minimum of 30% of MPR. Roughly, the average bank right now pays about 1% on that. So that means it goes to a minimum of 3.6%. If you consider, take a bank that, for instance, even savings deposits is just a quarter of earnings, you're talking about 60, 70 basis points, increment in funding costs, which is significant in terms of those constrained revenue.
So, but given all this, are you still bullish about the sector?
Yeah, largely we're very bullish on the sector. We think that the banks.
So other things will compensate in terms of growth of loans, or what are your thoughts on this?
Certainly, we think that we're very much in the recovery phase for the banking sector as a whole. If you look at valuations from where they stand right now, still pretty attractive. I think average P's within the sector is somewhere between 7 to 7.5 times. But more importantly, we're looking at a situation in which the banks are more operationally sound and better equipped to take advantage of opportunities, within the system. One of the big things that we're looking to was the power sector reform, which we felt to provide a lot of revenue opportunities. In spite of the fact that has slowed down a bit coming into this year in terms of materialization, we think that what's happening on the government security space provides more than ample revenue opportunity. CBN has done almost roughly in excess of 2.5 trillion net issuance just in H1 2012 alone. That provides a lot of room for the banks to tap into. So we think that a lot of them are also, based on the strategy and our discussions with them, focused on that government revenue space in terms of just sustaining the.
Let's focus on a few of those banks. Clearly, we have quite a number, over 21 banks in the market, and quite a few are listed. So let's focus on Access Bank, because they've recently announced a new 5-year strategy. Many people suggest it's really not. There wasn't too much that was different from what we knew about Access Bank going forward. There was a bit of an emphasis on retail banking, though. So I want to get your thoughts on Access Bank going forward. Your thoughts on that bank?
Certainly, I think a lot of what they communicated, the 5-year strategy plan, certainly was qualitative. But I didn't think it made it any less important than actual financial numbers, because it was good to get a sense of the strategy that the bank was looking to pursue going forward. I haven't been able to achieve that scale that's sought after for so long with the acquisition of Intercontinental Bank, and it was good to get a shape of the direction that we expect to see. I think as far as the drive of retail banking goes, I think it's a very big positive. Because for us, after all is said and done with the government securities and one or two opportunities in the reforms and corporate space, we think longer term, right? The future of the industry really settles in the retail space.
When you say the future, let's look 5-10 years from now. Do you get the sense that the importance of retail banking in the context of banking revenues as a whole will grow to, say, 50% perhaps?
Well, I may not be able to give actual numbers, but certainly. And I think over an even longer time horizon, it will probably come to dominate even what we have in terms of the corporate space.
Right.
Because what you have
a lot of people do say that the structures here do not necessarily favor retail banking. Like you've seen retail banking take off very well in a place like Kenya, and they said the underlying infrastructure is what has supported that. We don't necessarily have that here in terms of identifying people and stuff like that. So are you still that bullish that retail banking can work the way it has worked elsewhere?
Which is why we think it's more of a long-term opportunity. But certainly it can, because at the very minimum, what we think you could start with right now is simply focus on those that are already within your captive market. So you have employees of institutions, right. You have individuals that relate with other institutions that you give credit to. I think that's what a lot of the banks are focusing on, really. If you look at the demographics, I think it's a no-brainer over the longer term. And if you're going to wait for the infrastructure, I think you might eventually end up not doing anything. Right. So you've got to start from somewhere. And the key thing, I think, for the banks, the concern is around delinquencies in terms of retail lending. And most of that you're going to take care of simply by deploying the appropriate technology, both for issuing that credit as well as for monitoring it. And if you do that within the captive market of employees of corporate institutions within which you already have some sort of relationship, I think that sort of mitigates a lot of the risk for the banks.
But would that give you the 50% contribution?
It will not give you, but will give you the foothold. It will give you the experience. It will give you some sort of pro forma interaction based on which you can then build further out for the retail banking space. I think for a lot of the banks, I think what they need to do is to be able to realize that this potential is there. They all know that it's there. Right. Everybody's waiting for who's going to take the first step. Okay, we need to wrap this up.
A final word on the earnings season, Q2, what to anticipate. Generally, are you optimistic that we're going to see good numbers? You've raised a few areas of concern there in terms of the pressure on revenues, but are you broadly optimistic that we'll see good numbers?
I think we'll see numbers broadly in line with our expectations, which are slightly lower from where we started the year. Right. But I think it's not something that should create a lot of concern, really, for investors. Because broadly, like I said, valuations are still very much attractive. We don't expect profit growth to slow down significantly. I think a lot of those pressures will probably be offset by some of the efficiency initiatives over the last 1-2 years.